if you go into any equity investment, you should expect to have some down years. So the market in general is positive about 86% of the time. That means that the market is negative about 14% of the time. So whenever you say, the S&P has averaged, let's say 12% over the last 50 years, it doesn't mean that the market's done 12% every year. In fact, it doesn't even mean that the market's positive every year. But when you look at 10-year periods, the market is, you have a very low chance of being worse off than where you started 10 years ago. Now, if your risk tolerance is not there, if being down 15 to 18% prompts you to want to sell something, you should probably avoid most type of equity investments in the first place. But if you're going to do that, if you're going to sell this and you're going to go to something different, you're going to have to really reset your return expectations. So if you want to stay in something that is, only going to give you the opportunity for positive returns, that means you're going to be limited pretty much to CDs and money market. And CDs and money market right now, they're paying about 5%, but we just come off a couple of decades where you made between 1% and 3%. So there's a give and take relationship there. If you don't have a long-term time horizon, you should not be in equities at all. So, for some of us, sometimes it's just a matter of resetting expectations. So if you're going into ETF 5, for example, you should have a long-term time horizon. If you don't, you should avoid it. What's happening with that ETF right now is perfectly normal. It's not fun for it to happen in the very beginning, but you have to know going into these types of things that you will have down years. And if you're adding into that position, you really might be a little bit excited about it being down, because that means that you get some of those same shares on sale.